On last Friday, spot gold broke through its previous high to hit a new all-time high, finishing with a strong consolidation and consolidating the bullish trend. Spot gold rose by $45.17, or 0.92%, closing at $4,981.83 per ounce. It achieved 5 consecutive days of gains, with the cumulative monthly increase exceeding 10%, highlighting its strong momentum. The upward movement of gold prices this time is the result of the triple resonance of geopolitical risks, monetary policy expectations, and institutional allocation demands. Geopolitical risks serve as the core driver. The dispute over Greenland's sovereignty has not eased, as the local government denied the details of the so-called framework agreement reached by the U.S. and Europe, emphasizing that sovereignty is an inviolable red line. The rift between the U.S. and Europe has intensified the power struggle in the Arctic region, keeping market risk aversion sentiment at a high level, coupled with the continuous deployment of U.S. troops in the Middle East and U.S. intervention in Venezuela triggering concerns about global energy supply. The superposition of multiple risks has prompted investors to rush to buy gold as a safe haven, further boosting the appeal of gold prices. Expectations of Federal Reserve easing and a weakening U.S. dollar have provided key support for gold prices. The U.S. Core PC price index rose by 2.8% year-on-year, indicating a moderate inflation level. The market expects the Federal Reserve to cut interest rates by 25 basis points, twice in the second half of this year, with the probability of a rate cut in March exceeding 50% in a low interest rate environment. The holding cost of non-yielding assets like gold is significantly reduced, naturally enhancing its attractiveness. In addition, Trump's intervention in the Federal Reserve's personnel arrangements has raised concerns about the independence of monetary policy, further strengthening easing expectations. Affected by these factors, the U.S. dollar index plummeted by 0.94% to 97.2550 on Friday, which not only lowered the gold purchase cost for non-U.S. currency holders, but also reflected the shaky credit of the U.S. dollar amid the de-dollarization wave. Central banks of many European countries plan to reduce their holdings of U.S. treasuries and increase their gold reserves, enhancing the reserve attribute of gold. Continuous buying by institutions and global central banks has acted as a shot in the arm for gold's record high breakthrough, driving gold into a phase of asset revaluation. Holdings of the world's largest gold ETF, SPDR Gold Trust, increased to 1,079.66 tons, a new high in more than 2 years. The People's Bank of China has maintained net gold purchases for 14 consecutive months, and the National Bank of Poland also plans to add 150 tons of gold to its reserves. Global central bank gold reserves have hit a 30-year high, with gold gradually evolving from a short-term safe haven tool to a core asset for hedging U.S. dollar risks and geopolitical uncertainties. Investors are closely monitoring the results of the Federal Reserve's interest rate meeting on January 27th to 28th, the progress of the Greenland Agreement, the pace of central bank gold purchases, and the trend of the U.S. dollar. A break of the 97 level by the U.S. dollar will further open up upside space for gold prices. All content is for reference only and does not constitute investment advice. Investors should bear their own profits and losses if they trade based on this content. Please subscribe, like, and share. Thank you for watching.